Think Nevada's housing market is strong. Think again. In just the past 2 years, the state has already lost over $147 billion in home equity, and experts warn the pain is only starting. Mortgage delinquencies are climbing, foreclosure filings have surged by double digits, and over 70% of Nevada households are now cost-burdened, spending more than a third of their income on housing. In Las Vegas alone, median home prices jumped nearly 90% since 2020, while wages barely moved. And that's before the real storm even begins. I have all the information, so now let's see why Nevada home prices will crash in 2026. 1. The water crisis that will destroy property values. Nevada's most urgent problem isn't housing prices, it's water. The entire state relies on the Colorado River, and its lifeline, Lake Mead, is at historic lows. Federal projections show water levels dropping so fast that by 2026, Nevada faces cuts of up to 35% of its allocation. That's not just an inconvenience, it's a death sentence for growth. Over 1.7 million properties in Clark County depend on water from this shrinking reservoir. Developers are already halting projects because they can't guarantee supply, while existing homeowners face declining values as buyers shy away from drought risk areas. Insurance companies are quietly pulling back, citing water scarcity as an uninsurable risk. The numbers make it worse. Lake Mead currently sits at just 37% of capacity, down from more than 90% in the year 2000. If the dead pool threshold is reached, hydroelectric power for more than 1.3 million people could vanish along with the water supply. California, which has senior rights to 4.4 million acre-feet annually, gets priority access over Nevada's meager 300,000 acre-feet, leaving the Silver State with little leverage. Analysts warn property values in Las Vegas could collapse by as much as 60% if the crisis escalates. Wall Street knows it. Hedge funds are already betting billions against Nevada's water rights, treating the state's housing market as a short opportunity, not a growth story. For decades, Nevada marketed itself as a land of endless opportunity, but without water, those promises evaporate. A house without water isn't just less valuable, it's worthless. 2. The hidden unemployment tsunami. Official reports claim Nevada's unemployment rate is manageable, but the reality is far worse. When you include discouraged workers and underemployment, the true figure is closer to 12%, nearly double the national average. That gap represents tens of thousands of households already on the financial edge. And the outlook is even darker. Major employers like Amazon and Walmart have announced plans for mass layoffs in Nevada distribution centers. At the same time, the rise of automation is cutting deep into casino, retail, and logistics jobs, the very industries that sustain Nevada's middle class. In fact, industry studies estimate that by 2026, automation could eliminate more than 35,000 positions statewide. That's on top of the 14,000 layoffs already announced in tourism-related sectors since 2023. The state's unemployment insurance fund is already fragile, with reserves covering only 6 months of claims, half of what's recommended by federal standards. If unemployment spikes, the fund could run dry by late 2026, forcing borrowing or benefit cuts. For struggling families, that means no cushion, no help, and no time. This hidden tsunami isn't in the headlines yet, but it's building offshore. When it hits, it will swamp Nevada's economy, flooding the real estate market with forced sales and abandoned properties. 3. The California revenge migration. For years, California residents fleeing high prices and taxes poured into Nevada, fueling its housing boom, but the trend is shifting. Rising crime, water shortages, and collapsing affordability in Nevada are pushing many to reconsider. Some are moving back to California, while others are skipping Nevada altogether for states like Texas, Arizona, and Idaho. This reversal is what experts are calling the California revenge migration. It's not just that fewer Californians are coming, it's that many who came during the pandemic are leaving again. They sold high in Los Angeles or San Francisco, bought in Nevada, and now realize the affordable dream has turned into a nightmare of insurance hikes, water rationing, and stagnant job markets. The numbers are stark. According to US Census migration data, Nevada's net inbound migration dropped by over 40% between 2021 and 2023, and Clark County actually recorded net outmigration of more than 12,000 residents in 2024. Meanwhile, Texas attracted nearly 475,000 new residents, Arizona gained over 65,000, and Idaho saw growth rates double Nevada's. Without this steady inflow of Californians bringing cash, Nevada's fragile market is exposed. The state's housing boom was never grounded in local wages. The median income remains around $70,000, far below what's needed to afford $430,000 median home prices in Las Vegas. Instead, it relied on outsiders paying premiums. Now that cash is flowing elsewhere, Nevada is left holding the bag. Sellers are slashing prices, investors are pulling back, and the very foundation of the boom, the California pipeline, is drying up. 4. The mortgage fraud scandal about to explode. If the economic fundamentals weren't bad enough, there's another storm brewing. Mortgage fraud. During the housing frenzy of 2020 to 2023, banks and brokers pushed risky loans to keep the boom alive. Adjustable rate mortgages, ARMs, stated income loans, and even loans with minimal verification surged in Nevada. Many of these loans were structured under the assumption that prices would always rise. But with values stagnating or falling, cracks are appearing. Regulators are now investigating claims of widespread income misrepresentation, eerily similar to the fraud that fueled the 2008 collapse. Early audits suggest up to 18% of loans issued in Las Vegas between 2021 and 2023 may contain false or exaggerated income statements. By 2026, more than $12 billion in ARMs are scheduled to reset in Nevada, pushing monthly payments higher by $500 to $1,200 per household. For families already dedicating over 40% of their income to housing, these increases will be unbearable. Analysts project foreclosure filings could jump by 30% to 40% in Clark County alone once the resets hit. What makes this scandal especially dangerous is timing. It's set to unfold just as Nevada faces its other economic headwinds. Mortgage fraud doesn't just hurt banks, it destroys neighborhoods, floods the market with distressed sales, and drags down values for everyone. 5. Las Vegas, the casino economy collapse. Las Vegas is Nevada's crown jewel, but the glitter hides a fragile reality. The city's economy is built on casinos, conventions, and entertainment, all highly cyclical industries. When tourism slows, the entire local economy feels the pain. After a strong rebound in 2022 and 2023, growth in visitor numbers has plateaued. Rising airfare, inflation, and shifting consumer habits are reducing discretionary spending on travel and gaming. Industry insiders warn that convention bookings for 2025 and 2026 are down significantly compared to pre-pandemic highs. This slowdown is already hitting housing. Over 32,000 residents left Las Vegas since 2023, citing rising costs and declining quality of life. Mortgage delinquencies in Clark County are rising faster than the national average, while inventory on the MLS has surged by over 40% year over year. Las Vegas marketed itself as recession-proof, but history says otherwise. In 2008, the city became ground zero for foreclosures, with entire neighborhoods abandoned. Today, the warning signs look eerily familiar: speculative development, over-leveraged households, and an economy tied to a single volatile industry. The casino floors may still shine, but behind the neon lights, Las Vegas is bracing for another collapse. 6. Reno's tech bubble bursting. For years, Reno was marketed as the next Silicon Valley light. Big tech companies and logistics giants set up shop here, lured by tax breaks and cheap land. Tesla's Gigafactory, Apple's data centers, and a wave of startups promised a new era of prosperity. Housing prices followed, with Reno's median home value soaring past $500,000, almost doubling in less than a decade. But the cracks are showing. Many of those promised jobs never materialized at scale, and the salaries that did arrive often fell short of the hype. Average household income in Reno lingers around $75,000, a fraction of what's needed to comfortably afford the city's inflated home prices. The tech sector itself is facing headwinds. Tesla has announced slowdowns in expansion, while smaller startups are cutting staff. Venture capital, once flowing freely into Reno, is drying up as investors retreat from risky bets in secondary markets. Office vacancy rates have climbed sharply, and commercial landlords are offering concessions just to keep tenants. This is the same pattern we saw in places like Sacramento before the 2008 crash, a city propped up by hype and migration, not by sustainable wages. And when the hype fades, the housing bubble pops. Reno's tech future is starting to look more like a mirage. 7. The Airbnb apocalypse short-term rentals were once Nevada's golden goose. Investors bought up homes in Las Vegas, Reno, and Lake Tahoe, betting on endless streams of tourists. At the peak, thousands of properties were pulled from the long-term rental market and converted into Airbnbs. Rents skyrocketed, locals were priced out, and profits seemed unstoppable. But in 2024 and 2025, occupancy rates plunged by nearly 15% statewide. Tourists are traveling less, oversupply has flooded the market, and local governments are cracking down with stricter regulations and higher taxes. Suddenly, those once profitable properties are bleeding money. In Las Vegas, data shows more than 30% of short-term rental owners are now listing their homes for sale, desperate to offload before foreclosure. Reno has seen a similar trend, with inventory surging in neighborhoods once dominated by investors. This isn't just a dip in profits, it's the collapse of a business model. When Airbnbs flood the resale market, they drag down prices for everyone. Homes that were once artificially propped up by tourist demand suddenly compete with traditional listings, creating downward pressure across entire zip codes. The so-called Airbnb boom has turned into an apocalypse, and Nevada is ground zero. 8. The insurance crisis. As if water shortages, job losses, and collapsing demand weren't enough, Nevada faces another silent killer: insurance. Across the state, premiums have doubled in just 5 years, driven by wildfire risk, flooding concerns, and yes, even water scarcity. Some insurers have already pulled out of Nevada entirely, refusing to write new policies. Others are charging astronomical rates that make homeownership unaffordable. In parts of Clark County, annual premiums have surged past $6,000. More than double what families paid in 2020. In Washoe County, homes near wildfire zones face hikes of 40% to 60%, with some households now paying $8,500 a year just for basic coverage. And the trend is accelerating. In 2023 alone, Nevada homeowners saw average premium increases of 27%, one of the highest jumps in the nation. According to the Nevada Division of Insurance, at least 5 major insurers have stopped offering new homeowners policies in high-risk areas since 2022. For buyers, this is a deal breaker. Even if they can manage the mortgage, the insurance cost pushes monthly payments over the edge. For sellers, it's a nightmare. Fewer buyers willing to take on the risk, and without insurance, banks won't underwrite mortgages at all, leaving entire neighborhoods effectively unsellable. The insurance exodus is a death spiral. Rising risks drive insurers out. Fewer policies mean fewer buyers, and fewer buyers mean collapsing prices. In California, nearly 350,000 homes lost coverage in 2022 alone due to insurer withdrawals. Nevada is now walking the same path, and the housing fallout could be even worse. 9. The construction defect time bomb. Nevada's housing boom brought a frenzy of new construction. Entire subdivisions rose overnight, promising luxury at affordable prices. But in the rush to build, quality often took a back seat. State records show a surge in complaints over shoddy workmanship, cracked foundations, leaky roofs, faulty plumbing, and electrical systems that barely meet code. Lawsuits are mounting, with some developers already facing class actions. Industry insiders estimate that tens of thousands of homes built since 2019 could be at risk of significant structural issues, and the scale of the problem is only beginning to surface. Many of these defects won't reveal themselves for years, meaning buyers today could inherit ticking liabilities they never saw coming. Entire developments risk being branded as unsafe, stigmatizing neighborhoods for decades. When banks see these red flags, they pull financing. When insurers calculate the risk, they hike rates. That toxic mix doesn't just hurt unlucky owners, it poisons the entire market. This isn't just about repair. When word spreads that a neighborhood has widespread defects, values plummet, buyers steer clear, lenders hesitate, and insurance companies raise premiums. Homeowners are left trapped in properties they can't sell without massive losses. It's a ticking time bomb, and when it detonates, it will add yet another layer of downward pressure on Nevada's already shaky market. 10. The zombie mortgage crisis. One of the darkest legacies of the 2008 crash was the rise of zombie mortgages and loans that were never fully resolved, leaving homeowners trapped in legal limbo. And now, Nevada is seeing the phenomenon resurface. Thousands of old second liens and home equity loans, long thought forgotten, are being revived by debt collectors. Families who thought they were safe suddenly receive foreclosure notices for debts they didn't even realize were still active. These zombie mortgages are reappearing just as new financial stress is hitting households households, creating a perfect storm. The numbers are staggering. Consumer advocacy groups estimate more than 15,000 Nevada homeowners could be at risk from revived zombie debts. Each case represents not just financial ruin for a family, but another distressed property dumped onto the market. In Clark County alone, housing analysts warn that up to 1 in 12 mortgages carries some form of secondary lien exposure that could be activated. The financial damage goes beyond individual families. Neighborhoods hit by zombie foreclosures often see property values fall by 15% to 25% within 2 years, as vacant homes attract crime, vandalism, and blight. In 2009, this cycle devastated entire suburbs of Las Vegas, leaving behind over 65,000 empty homes at the peak of the crisis. In 2026, history may repeat itself. With interest rates high, income stagnant, and debt collectors aggressively pursuing old claims, zombie mortgages could drag Nevada back into a spiral of abandoned properties, collapsing tax revenues, and falling prices that spread far beyond housing. 11. The 2026 converge. Individually, each of these problems is devastating, but together, they create what analysts are calling the 2026 converge, a perfect storm of economic shocks hitting Nevada all at once. $47 billion in commercial real estate loans are set to mature in Nevada during 2026. With office vacancies high and retail struggling, many of these loans will default, sending shockwaves through local banks. Federal infrastructure spending, which has been propping up thousands of construction jobs, ends in the first quarter of 2026. Once that money dries up, employment in the building trades could collapse overnight. Adjustable rate mortgage resets peak in mid-2026, raising payments by hundreds of dollars per month for thousands of households. For many, it will be the breaking point. Nevada's state budget faces a projected shortfall as tax revenues plunge, leaving less money for essential services just when residents need them most. And of course, the water crisis, the backdrop to all of this, threatens to cripple the state's ability to grow or even sustain its current population. This isn't speculation. Each of these events is scheduled, baked into the calendar, and unavoidable. The only question is how severe the fallout will be when they all collide. And if you're finding this breakdown helpful, don't forget to subscribe. We track housing market realities that most media outlets won't touch, giving you the facts before the crash hits your doorstep. 12. The investment exodus. Nevada's real estate boom was never just about families buying homes. It was about investors piling in, chasing quick profits. Hedge funds, private equity groups, and corporate landlords bought thousands of properties, betting on endless growth. In Clark County alone, institutional investors accounted for nearly 1 in 5 home purchases between 2020 and 2022, with some neighborhoods reporting figures closer to 30%. But that tide is turning. Wall Street doesn't play sentimental games. They follow the numbers, and the numbers are flashing red. Rising interest rates have slashed returns on rentals, insurance costs have doubled, and property values are slipping. The yield on single-family rentals in Las Vegas, once over 7% in 2021, has now fallen below 4% in 2024, barely enough to cover inflation. Suddenly, the same funds that flooded Nevada are racing for the exits. We're already seeing the early signs. Bulk sales of rental portfolios are hitting the market, sometimes at discounts of 15% to 20%. Blackstone, Invitation Homes, and smaller REITs have begun trimming their holdings, citing market risk. Even Airbnb-focused investors are cashing out, dumping properties before the bottom falls out. In fact, MLS data shows investor-owned listings in Clark County surged by 38% year over year in late 2024. And when big money runs, it sends a signal to smaller investors and ordinary homeowners. Panic spreads, confidence collapses, and the market enters a death spiral. The investment exodus isn't just a blip, it's the moment the illusion shatters, leaving Nevada's housing market to fend for itself. 13. The buyer collapse. Every housing market depends on one thing: buyers. And in Nevada, buyers are vanishing. Affordability has completely collapsed. With median home prices in Las Vegas near $430,000 and mortgage rates stuck around 7%, the typical monthly payment is now over $2,900, a figure completely out of reach for households earning the state's median income of just $70,000. That means the dream of homeownership is now mathematically impossible for most Nevada families. In fact, housing economists estimate that only 18% of households in Clark County can now qualify for a median-priced home under standard lending rules. At the same time, credit standards are tightening. Banks burned in the last housing crash are refusing to take risks, requiring down payments of 20% or more, which translates to nearly $86,000 upfront in Las Vegas. First-time buyers who once drove demand are being locked out entirely. Even those with the means to buy are holding back. Why purchase now when prices are falling and inventory is rising? Across Nevada, MLS data shows listings sitting an average of 52 days on market, up from just 21 days in 2021. In Reno, nearly 30% of homes reduced asking prices in the last quarter alone, and in Henderson, the figure is closer to 35%. This is how demand collapses, slowly at first, then all at once. Sellers can drop prices, offer incentives, or beg for offers, but without buyers, the market stalls, and a stalled market is a crashing market. 14. The government can't save this. In the past, when housing markets stumbled, governments stepped in with bailouts, subsidies, or emergency programs. But Nevada's crisis is different. This time, the problems are too big, too structural, and too interconnected for quick fixes. Start with the state budget. Nevada relies heavily on gaming and tourism taxes, both of which are under pressure. Projections already show a multi-billion-dollar shortfall by 2026, leaving little room for large-scale interventions. Even if lawmakers wanted to roll out relief programs, the money simply isn't there. Federal help isn't guaranteed either. Washington is facing its own fiscal challenges, and Nevada doesn't have the political clout of larger states like California, Texas, or New York. Any relief that does come will likely be limited and slow, not nearly enough to offset the wave of foreclosures and defaults barreling toward the market. Meanwhile, the structural issues like the water crisis, insurance collapse, and speculative overbuilding aren't problems that can be solved with a stimulus check. You can't legislate rain, you can't order Wall Street to stop fleeing, and you can't magically erase trillions in unsustainable housing debt. This is why analysts warn that Nevada's housing crash will be deeper and longer than the 2008 crisis. It isn't just a financial bubble, it's a systemic unraveling that government can't stop. 15. Your action plan. So what can you do if you live in Nevada, or if you're thinking about buying here? The first step is brutal honesty. Acknowledge that the market is heading into a storm and plan accordingly. If you're a homeowner sitting on equity, consider your position carefully. Waiting could mean watching that equity evaporate. Selling sooner, even at a discount, may preserve value that could vanish in a year. If you plan to stay long-term, focus on securing stability. Lock in fixed-rate financing, reduce other debts, and prepare for higher insurance and utility costs. If you're an investor, the time for blind optimism is over. Look at fundamentals, not hype. Avoid areas heavily dependent on tourism or water-intensive development. Scrutinize rental yields carefully after factoring in insurance, taxes, and vacancies. Many so-called profitable properties are already cash flow negative. For renters, the crash may bring opportunity. As prices fall, landlords may become more willing to negotiate, and eventually homes will re-enter the market at realistic prices. Patience will be rewarded, and for those tempted to buy the dip, remember this: timing matters. In 2009, prices didn't bottom overnight. They fell for years before stabilizing. Jumping in too early could leave you underwater for a decade. Above all, stay informed. Nevada's housing market isn't just going through a correction, it's heading into a structural collapse. Understanding the risks now is the difference between financial survival and ruin. Nevada's housing market is cracking wide open, and the fallout is unavoidable. Protect yourself, plan wisely, and don't ignore the warning signs. Stay ahead of the crash. Subscribe now, because the next housing disaster could be closer than you think.